Yeah. Over to you, Paul.
Perfect. Thanks very much, Declan. And morning, everybody. Great to get the opportunity to meet you. So just by way of introduction, my name is Paul Daly. I've been, let me see, I've taken a sideways move in the last kind of 5, 6 years. So I'm not working in credit or collections these days. But prior to that, I was working for 14 years in both the credit and collections industry. I worked for Oracle for a year or so. I worked for Philips for a couple of years. And most of that time, I've been working with Accenture. I worked with one of their diamond clients for a total of 12 years. So did all of their products, all of their regions, spent some time in risk, spent some time in collections. And we broke it up and we changed it around and we did it all sorts of different ways and so on. So I've done it by product and done it by region as well. So I've done pretty much every region. So that's just a quick introduction in terms of myself. And I suppose most importantly, I've been working with Declan now for the last, I think it's now 11, 12 years now at this stage. But going back prior to that, I was sitting where you were sitting, although we weren't remote back then. So I did the course myself. So I remember it. I remember it well. Okay, but first and foremost, welcome aboard, and looking forward to getting the opportunity to work with you. Okay. So what we're going to do today, as Declan said, is we're just going to do a whistle-stop tour through the material in credit management. We're not going to go into any massive detail or anything. I will stop and from pause from time to time and give one or two examples to back up some of the things that I'm talking about. But we're not going to go into any massive detail on anything. The notes take care of that. And then obviously, if there's anything in the notes that's unclear, as Declan said, you can reach out to me as we go along. So there's certainly no need for any frantic writing of notes or anything like that. Or just because all of it will be contained in the notes when you get them in the case of module 1 on Monday. Okay. So we'll jump right into it. So credit management from a business point of view is a very, very powerful tool. And the reason that it's a very powerful tool is it allows you to make sales that you wouldn't otherwise be able to make. So if you take the example of a car, a lot of people buy cars either on hire purchase or or some form of financing. And instead of having to have maybe 30, 40,000 available sitting in the bank to hand over to the car dealership, they can repay the cost of the car over a number of years, and they pay maybe 2, 3, 400 a month, something like that. Okay, so it allows the seller to get business that they would otherwise not be able to get. So it's a very, very powerful tool and allows for an awful lot of business to take place that otherwise would not take place. Okay. But albeit a very powerful tool, it is something that needs to be carefully managed. Okay, if it's carefully managed, it remains the powerful tool that it is. If it is not carefully managed, you can potentially have a scenario where it can drive a company into bankruptcy. Okay, so it does need to be very carefully managed, and you guys working in that business perform a very important role in ensuring that the money comes in and that the business can continue running. Okay, so credit needs to be managed in a very careful way in order to make sure that it can be used in a positive way and doesn't end up having negative consequences. So the way that credit is managed, this is a model that Declan has come up with, is to manage credit effectively, you need to employ what is known as the ATTACK model, okay? ATTACK, the ATTACK model, which Declan has come up with, all right? So each of these letters stands for something, and each of them will be covered in the modules, okay? So the first A stands for assessment, which we'll be covering off in module 1. First T stands for terms and conditions, which we'll be covering off in module 3. The second T stands for teamwork, which is in the second part of module 3. The second A stands for administration, which we'll be covering off in module 2. The C, not too surprisingly, stands for collections, which we'll be covering off in the final module, in module 4. And then finally, the K stands for key performance indicators, which we'll be covering off in module 2, okay? So essentially what we're saying is if you get these 6 elements of your business right, and there's an awful lot of subsets, which we're going to go through as we go through the modules now, but if you get these 6 core elements right, you are setting yourself up for success in terms of managing your credit function, okay? So the ATTACK model is something that we refer to throughout the course. It is the I suppose the skeleton on which we then add the meat to in terms of the course. So module 1 covers assessment. Okay, first of the 2 A's. All right. So when we're talking about credit comes from the Latin verb credare, okay, which means to believe or to trust. Okay, so when we are offering credit to our customer, we are trusting them that we are giving them a product or service today, and we're trusting them that at some point, some pre-agreed point in the future, not some point, but some pre-agreed point in the future, that customer is going to pay us back the money that we have given them. Okay, and in certain cases, there'll be interest on top of that. Okay. But if you're doing that, you need to be asking yourself a couple of key questions before you offer the credit. Okay, one of which is, do I need to offer credit in order to get this business? Okay, if you can do it without offering the credit, it's usually a good option to just take the money up front. But assuming you're going to offer credit, there's a couple of questions you need to ask yourself. First question is, who am I trusting? Okay, you need to know something about the customer that you are offering the credit to. Based on what you find out, you then ask yourself, okay, how much am I going to trust them with? Okay, you then ask yourself, how long am I going to trust them for? So how long is it before I want the money back? And then finally, as I said before, are they both willing and able to pay the full amount back on the due date that you have agreed? Okay, so who am I trusting? How much am I trusting them with? How long am I going to trust them for? And are they willing and able to pay the full amount back on the due date? Okay, so those are the questions you need to ask. Okay, and in terms of the first part, who am I trusting? It's important to know a certain amount of detail about the customer that you're selling to. Okay, so first and foremost, what type of business am I dealing with? Assuming it's a business-to-business transaction that you're doing, what sort of business am I lending to? Is it a sole trader? Is it a limited company? Is it a charity? Is it something else? Okay, is it a partnership? You need to ask yourself, okay, what sort of company am I dealing with? Okay, and if we take an example, a key reason why you want to know that is because this will have a very important part in the event that you start struggling to get your money back. Okay, if you're lending money to a sole trader and that sole trader drives around in a car worth 150,000, if that relationship goes wrong and you need to try and enforce the debt and you start going down legal routes, potentially that 150,000 euro car may possibly be up for grabs to discharge the debt. Okay, so it's important. So that's a sole trader. The sole trader is the business. Okay, the business and the person are one. So that car potentially is available to go after to discharge the debt. If, however, you're dealing with a limited company and things go sour and you're not able to recuperate your debt, if that 150,000 euro car, if that 150,000 euro car is registered in the name of the company and is a company asset, yeah, absolutely, it's available to potentially be used to discharge the debt. However, if that car belongs to the director and is in the name of the director only, you have no option to get it, even if you end up having to write off the debt. And that person continues to be able to drive around in their car, you cannot use that car to discharge the debt because the business and the person are separate. Okay. All right. So the first question you're asking is, okay, so what sort of company am I going to be dealing with? And there's a number of advantages of dealing with sole traders, a number of advantages of dealing with limited companies, among other things, the amount of information that they have to make available to the wider world. So there are a number of advantages, number of disadvantages. You can deal with both. There's no problem dealing with both, but knowing that information is very important. Okay. So how do you find out that information? The way you find out that information is you're going to get your customer to complete a credit application form. Okay. Now, there's going to be a lot more on the credit application form than are you a sole trader or are you a limited company? But that is one of the questions you can ask. Okay. Now, the credit application form performs a number of functions. It's an information gathering tool, so it allows you to gather within reason. You don't necessarily want to make it so long that you put off the customer from doing business with you at all. But it is an information gathering tool. It's a tool that can be used to assess whether or not, the part 2 and 3, the amount of credit you're going to offer and how long the credit terms are going to be. It's a collection and enforcement tool, okay? And it's also a legal document. So it will be signed at the bottom that says, okay, I agree to abide by the terms and conditions of your company and I will repay my debts on time and things like that. So there's a number of functions that the credit application form performs. For me, purely personally, there's three key things that I like to see in a credit application form. Okay. First one is get as much credit information within reason, as much credit information as you can. And that would apply for business to business, but also business to consumer type credit. Okay. What type of company are we dealing with? What is their business? Very, very important. Okay. You need to know, are they selling the next big thing? Next big thing sometimes works, sometimes doesn't. Or are they selling a product that's very much in decline? You need to know what type of business they're doing. How many employees do they have? How long are they in operation? If they've been in operation for 50 years, there's probably a reasonable chance they're going to get to 51. If they've been in operation 1 year, unfortunately, a lot of companies after between 1 year and 2 year will close. Okay. Are the buildings owned and leased? Getting back to, can you go after the assets? Those are all key things to find out. Okay. So a bit of credit information is very useful in the credit application form. The second thing I like to see on the credit application form is removing the excuses that the customer might use later on for not paying you on time. Okay. Very key one is PO numbers. Okay. There's probably very few people who have worked in credit that haven't had the PO number excuse pulled on them at some point. So, getting people to sign on the application form, whether or not the company uses PO numbers, it doesn't necessarily mean that you're going to get paid on time, but it makes it just a little bit harder for them to come back later and say, if you're able to pull out the application form and says, it says here, and I'll show it up on screen. It says here that you don't use credit, the PO numbers. Why are you now saying you do? It makes it a little bit harder for them to use it as an argument to not pay on time. Okay, so PO numbers. Do you receive statements or invoices electronically or manually? Because there's no point sending them by post if they need to all be uploaded onto something. And there's no point doing the reverse either if they need to have them all in hard copy. Okay, so what way do you receive your statements and your most importantly, almost your invoices? Okay, so look to remove the excuses as to why they can't pay on time. And then for me, the last thing to put on a credit application form is lots of contact details. Okay, you don't want to find out that the debt has now gone overdue, and then you look at the credit application form and the only contact details is maybe accounts at pauldaileylimited.com. And then you find the emails are not being responded to. Ideally, you have a number of different email addresses and a number of different phone numbers and a number of different people, and don't be afraid to ask for them. So, well, we can do with some more contact information. And a very good suggestion that actually appeared on one of our exams a couple of years back is somebody said, as soon as you get the credit application form, test those emails, test those phone numbers. Check that they're working. So you're not waiting till you've got $1 million debt outstanding before finding out that the email address has not been filled in correctly. Okay. So those are all things on the credit application form. There's a number of pages that we cover that off on in module 1. So I'll pause for breath and a slug of water. Does anyone have any questions on anything I've said so far? No, we're all good. Okay, next. Okay. So this is all part of, as I said, just to remind you what we're covering off, this is all part of the assessment side thing. So there's a lot of other things you can put in the credit application for, but those for me would be the three key things that I'd be looking out for. And so it's not one question, it's a number of questions that you'll probably need to cover those off, but I think it's very, very useful to put them in. Okay. The next question you're going to be asking yourself when you are issuing credit is how much can I trust them with? Okay, so I mentioned earlier, you want to find out what sort of business they're in. Are they the next big thing? Okay, if they are the next big thing and you are fairly certain that this is going to be a successful next big thing, which is not necessarily a given, you may want to extend a fairly generous credit line to say, okay, well, these guys are going to need an awful lot of product. That's an opportunity for us to make a lot of money. So let's extend them a big credit line. If, on the other hand, they are selling a product that is maybe, the demand is beginning to diminish in the market, and the company has not necessarily yet replaced it with something else, you may want to be a bit more conservative in terms of the credit line. Okay, so you need to ask yourself, is it going to be liberal or conservative credit line that you're going to issue? So you need to, that's all about weighing up the kind of credit information that you have, and also what you know about the general market. So keeping yourself informed as to what's going on in the business world is very important. Is it a secured or unsecured creditor? Okay, I mean, are you lending the money out but there's no security, or are you lending it out and you would fairly easily seize the company car, seize assets to discharge the debt? That's a question you need to ask yourself. How much do you trust your credit, your Collections team. Do you have a collections team? Okay, if you have a collections team, we're all hungry and ready to go, and we'll chase debt down with it being 1 or 2 days overdue. Then you can say, yeah, okay, we can probably afford to be fairly generous with our credits because we've got some stock gaps in there. And some controls that will allow us to just get the debt discharged. If you don't, and if people are doing collections maybe on the side and doing it at other jobs, and they may not get to it every day, you may want to be more conservative about the credit line that you issue. Okay. So the key message at the end of it all is get all the information you need to make an informed and intelligent decision as to how much credit you're going to give and for how long that you're going to give the credit. We'll come to the how long bit in a moment or two. It comes up in another topic, but that's essentially what's covered in Module 1. So Module 1 covers the first A in the attack model assessment. Okay. So assuming we're all good on that, I'm going to pass to Module 2. So that is what? Module 1 you'll be getting on Monday. So you're talking, what, I suppose the first half of December. Okay. And Module 2 covers off 2 other topics. Okay. It's going to cover off the second A, which is administration, which we're going to talk about in a minute. And then it covers off key performance indicators and the reporting side of credit management. Okay. So administration, first of all. So there's probably a fairly common perception in terms of credit management that if you have a good collections team and if your collections process is well managed and well run, well executed, that you are inevitably going to have a very successful credit side to your business, okay? And that's not necessarily the case, okay? You can have the best collectors in the world, but if you have problems everywhere else in the organization, it is unlikely that you're going to be successful in terms of managing, in terms of having good credit numbers and managing your credit function as well as you possibly can. So you need to go a lot further than just ask yourself, okay, how good are my collectors? Okay. You have to examine the entire order to cash process. Okay. And so the first thing you need to ask yourself is there's a number of checklists in Module 2. I'll just go through one of them. You need to ask yourself, have I got a list of potential customers? Do I have an action plan and a time scale to contact those customers? Do I have a way to ensure that all orders that are made but placed by a customer are recorded and actioned? Do I have a way of ensuring all orders are delivered in full? Do I have a way of ensuring that all those deliveries turn into invoices? Do those invoices have a way of getting onto a debtor's ledger? Do we know the invoices are all assigned to the correct customer account? Do we know that all the cash is posted to the correct account? Do we have a way that all cash is received and then properly allocated to the correct invoices? Do we have a way of dealing with disputes and part payments? Do we have a way that ensuring all customer accounts are correct? Do we have a way of making sure that every statement is correct before we send it? And do we have a way of checking our bank account every day so that we know whether or not money has arrived? Okay, so that's a lot wider than just saying, okay, do we have good collectors who will send out their dunnings on time and make their phone calls on time? You need to manage not just your collections team and your collections department. You need to manage every aspect of the order to cash process. You need to ensure that all of them are working. If all of them are working, and the answer is yes to those 13 questions, your chances of success is pretty high. If you do not, and if you have a number or even one of those 13 that is severely problematic, your chances of collecting successfully are severely diminished, okay? Because you have some part of your process broken, which is probably your company's fault and not your customers. And the customers will then use that as a reason not to pay on time, okay? So we're going to go through a lot of that, and we're going to show you how to get it right, okay? We're going to take you through your documentation, okay? We're going to show you what a good invoice and what a good credit note should look like, what should be on it, what should be not on it, in order for you to get to the top of the pile in accounts payable and get yourselves paid, okay? We are going to take you through your statements, okay? We're going to show you what a statement should look like, what should be on it and what should not be on it. There's a number of very key ones, and I suppose I'll give you a quick example because this is one that is a question on one of the short tests. How many columns should there be on your statement? And you know, if you've got experience in the credit industry, you may well have seen statements before, or if you ever worked in accounts payable, you might well have seen statements which says 0 to 30, 1 to 30, 31 to 60, 60 to 90, all those columns working their way across, maybe up to 360 or even up to 720, okay? But a key message is, if you see customers, if you see the columns go all the way up to 720, what that is subtly doing is it's subtly sending a message to your customers that there are some people on your ledger that have debt maybe up to 2 years old, okay? If they don't have debt up to 2 years old, why is there a column saying 720 on there, okay? It should all be 0, definitely. But if it should be 0, then delete it as a column. Don't have it. So what you're sending there, so in reality, there should actually only be 2. There should be, this is current and this is overdue, okay? So once it's overdue, for one reason or not, it should be collected, okay? Collected or actioned, resolved, whatever, but something should happen that gets rid of the debt once it's overdue, okay? So you should not have column after column after column that goes all the way and says, okay, we got that's 30, that's 60, that's 90 plus. It's problematic to have it all there, okay? So, so that's the statements. And we see, we'll take you through a number of different, there's a number of different iterations of checking all of your processes and making sure they're correct. So we'll go through all those. Let me see. If we turn our attention, so I mean that is the administration side of things. We turn our attention to the reporting side or the KPI side, which is the K in the attack model. I mean, my key message on this, I mean, there's a number of things. I'll quickly go through this, and then I have a key message to share with you. There's a number of things you should be checking every single day. Okay, if you're running your team correctly, you'll be checking these every single working day, at least once. Okay, and they are your bank statement, your unallocated cash, your invoices, your cash receipts, your lodgements. There's certain things you should be checking every week, which would be your cash received against your target that you have put together for the month. Your key and your high-risk customer balances should be checked at least once a month, whether they're overdue or not. Your uninvoiced dispatches and unbilled services, and your credit notes, okay? What are the reasons? Why are the credit notes being created? And what solutions can we put in place so that this problem doesn't happen in the first place, so that the right invoice goes out first time, okay? So those are things that you should be checking every week. And then every month, you should be checking your exposure to your high risk and your high balance accounts. Any credit insurance that you have in place, you need to be checking how those accounts are performing. And you need to also be asking yourself, okay, how are we performing this month versus last month? And equally, if not more importantly, how are we performing this month versus this month last year? How are we doing year to year? And how are we doing month to month? So I would hazard a guess that any poor performing collection teams, there's a pretty good chance they're not doing that, okay? They're probably checking stuff daily. They're probably checking stuff weekly that you should be checking daily. They're probably checking stuff monthly that you should be checking weekly, okay? And maybe the stuff that they're supposed to be checking monthly, they barely check it at all, okay? But if you do that, it's a fairly good recipe for problems. Because if you call a customer and they say, well, sure, I made the payment, and you haven't checked your bank account in 3 days, how do you know? You may well have to just take them at their word, and then they get off the phone, you check the bank account and say, hang on, that payment's not there at all, okay? And then, it's a bit awkward to then ring the customer back and kind of do it. You can be done, but ideally you would know, so no, I've checked our bank account, we don't have it, okay? All right, so there's a number of things you need to be checking every day, every week, every month, and we will take you through those as what they are and why it's important to do so. Any questions on any of that?
No, all good.
Super, thank you. Next. Okay, so the final part of module 2, check in, keep an eye on the clock. I either go too short or go too long. We're not so try and get it just right this time. Maybe first time ever, but we'll try and get it just right. The last section, part of section 2, is we deal with the payment, the methods of payment. Okay, so I suppose if you stop someone on the street and say, right, how many methods of payment are there? They might, they probably list cash, they probably list direct debits, they certainly list tap, which we've all become used to in the last number of years. But there's actually, I think 23, 24 that are listed in the notes, a variety of different sources of payment that are in there. We go into things like letters of credit. Some of them are becoming more and more outdated, such as checks and things like that. And there are various things that perform the same function, and may have a variety of different kind of slight variations, but there are actually, I think 23, 24 different types of payment that are listed in the notes, and we're going to take you through the advantages and disadvantages of all of those. Okay. Okay. And that is going to be module 2. So what we've done, so that takes us to the halfway point of the course. We have the 2 A's in the ticked off, and then we also have the reporting side. But sorry, the one final point I would important to make, and this is a very key point that we make on the reporting, is the way that we market our job. Okay, credit, the collection side of things frequently has a default of a kind of negative scenario. Okay, so you're talking about percentage overdue, you're talking about percentage 60 plus. Those are kind of negative things we talk about, but what we are going to show you how to do and discuss and show you the benefits of doing in module 2 is we are going to take you through and say, okay, instead of saying percentage accounts overdue, why don't we say percentage of accounts within terms? Okay, percentage of our ledger within terms. Okay, if you have 2% overdue, 2% sounds a bit high, you know. You balance it up and say, well, but 98% of it is within terms. 98% sounds an awful lot better than, you know, it's the same thing, but the messaging of it when you go up to the non-credit people in the company is a lot better. It's around 98% of accounts are within terms, or 98% of the debt are within terms. No, you can always strive to get to 90, 98.5, 99, but it sounds an awful lot better than your 2% overdue or your 10% overdue or whatever it is that you're dealing with. Okay, so we are going to show you some of the benefits and talk to you about some of how you report to the non-credit people in your organization and give the best possible, because you better believe the sales guys and the marketing guys are going to be, there's plenty of bad things that happen there as well. They're very good at kind of putting the bad things to one side and publicizing the really good stuff. So we need to be doing the same. Okay.
Yeah.
Okay. So that's I've given a good account of module 2. I will move on to module 3. Module 3 is the meatiest of the modules. There's quite a number of things in there. Okay, don't know if it's the longest, but it's certainly got the largest number of topics. Okay, so what we're covering off in module 3 is we are covering off the 2 T's. Okay, so we are covering off terms and conditions, and we're also covering off teamwork, and there's 1 or 2 other bits and pieces in there as well. That we're also going to be covering off. Okay, some of that may come loosely under one category or the other. Okay, so the first one is terms and conditions. Okay, so the key one, and the one that's always, certainly in my time in credit or collections, is certainly the one that tripped me up the most. The terms and conditions, it is the credit terms. Okay, so when somebody asks and says, okay, what are your credit terms? Excuse me, and you say 30 days. There are a number of different interpretations that can be applied to 30 days. Okay, is it 30 days from the date of the order? Is it 30 days from the date the order is dispatched? Is it 30 days from the date the order is delivered? Popular one that I certainly saw, I think mainly among German customers a few years back, 30 days from the date of the receipt of the invoice. Is it 30 days from the date of the invoice? Do invoices in January need to be paid right at the beginning of March? Or do they need to be paid by the end of March? Or what is it? But one thing you can be certain of, the customers, there will always be some customers who interpret the 30 days, the longest possible interpretation of 30 days that they can apply. Okay. And I know that if I'm tight for cash, that would be the way I would do it as well. Okay, so that one's definitely due today. This one, you could interpret it as being, we could take another week on that, and claim that we have read it a different way to it. They may well know that they're doing that, but what you want to do is you want to remove ambiguity and make it very, very, very clear as to what exactly your payment terms are. Okay, so we are going to show you and take you through on how to do that. Okay. Again, I was talking earlier, how long should you set your payment terms for? There's a number of different things that would take you through in the notes as to how you should how you should set your credit terms. The strength of your customer and the strength of your business is certainly ones that are key ones. Your cash flow requirements. Okay, there is no point in having 10 million that is owed to you from fairly legitimate and reliable customers if you have no money in the bank. Okay, there's no point having 10 million coming to you in about 45 days time, and maybe all those customers are going to pay you in 45 days time. There's no point doing that, and your bank account is zero. Okay, that is a problem. Okay, so you need to keep your credit terms short enough that you can still have money to run your business, pay your employees, all those very important things, pay your collectors. all those very important things like that. What is the market expectation? Okay, I know years ago we branched into the Middle East, and we started and we started discussing kind of credit terms, and we say, we were thinking maybe about 45 days, and this 45 days, you've got to be kidding me. So everybody gives us 90 days here. So there's no question of it being paid in 45 days. So 90 days. So you got to keep in mind, what does the market expect? Okay. Now, if you're a new player into the market and your product is so good that people are going to want to buy it regardless of what you offer them, yeah, you can put your own credit terms on there. But it'll need to be something special. Okay. If the market expectation is 90 days, which is long, you may need to do it. Okay. What is the financial strength of your buyer? Okay. If you're dealing with Tesco and you're selling biscuits, and Tesco are going to sell thousands of your biscuits every week and make you very rich, you may want to give them, you may want to say, well, listen, you can have fairly generous payment terms. If there's a shop around the corner that's going to sell a couple of them every week, and that's all, you may not want to give them as long before they pay you. Okay. There's a number of different things you can take into account. It's all in the notes. There's a number of different things to be taken into account when you are dealing with your credit term, your payment terms. So there's a lot of detail on that. We're going to take you through terms and conditions. Is one of the names on the top of the chapter. So we're going to take you through what the common mistakes are in terms of terms and conditions. Okay. What are some of the things? The main one being that people frequently only pull them out when things start going wrong. And the customer doesn't realize certain things are on it, and more importantly, maybe even we don't realize that certain things are on it, or more importantly, that certain things are not on it. So we'll take you through some of the common mistakes of terms and conditions, and talk you through how you can work to avoid those. We're going to take you through something known as Incoterms, which is to deal with international trade. Okay, and when I did the course myself, the Incoterms was a topic on the course. And the next day I did have a look at, we were dealing with international trade at the time. I did have a look at one of our invoices, and lo and behold, the Incoterm was on there. Okay, so what Incoterms deals with where the responsibility of the responsibility of the seller ends and the responsibility of the buyer begins. Okay, so you have a number of different. I think there's about 13 of them or so. We only do 7 of them on the notes, but there's 13 of them in total. But what it deals with is when the responsibility of the seller ends and the responsibility of the buyer begins. So at one extreme, you have what is known as Ex Works. Okay, so you market out to the world and you say, I've got this wonderful new product, and you say it's available in this warehouse that you can come and collect it in. And people contact you, they want to buy the product. They say, okay, do you deliver it? No, don't deliver it. Okay, so you have to come to the warehouse. That is where the responsibility begins and ends. Okay, so the buyers come to the warehouse, they pay the money, they carry out a very fragile product of some kind, and they drop it on the driveway as they're making the way to the car and the van. That is the buyer's problem, not the seller's problem. Okay, because you have agreed it is an Ex Works arrangement. Okay. At the other extreme, you have what is known as DDP, which is duty delivery paid. Is that right? Delivered duty paid. Okay, and that is one where you have agreed with the customer you are going to deliver it right to their door. So you've got a courier, you're delivering something. It's now gone off to maybe the Netherlands. You have a product, a fragile product. A delivery person takes it out of the van, walks up the driveway and drops it just as they're about to hand it over to the customer. That is the seller's responsibility, because it has been agreed that the buyer gets it into their hands, and only then does the responsibility transfer. And there are a variety of different versions of it from in between as well, as to where does it stop at Dublin Port? Does it stop at Rotterdam Port? Does it stop on the road from Rotterdam to the customer? Where does it stop? Okay. All right, so we're going to take you through all of that, okay? But you can see these are all things that can create rows, and these are all rows that can stop you getting paid on time if they are not clarified in advance, okay? The next thing we're going to cover off in Module 3 is your credit policy, okay? So, there's no doubt about it, to be a successful collector, you need to have drive and passion, but there should also be kind of a rules that you follow in terms of how you apply your business. You shouldn't really be, I suppose we've probably all done it, but you shouldn't really be putting accounts on hold just because I'm fed up with that account. I'm going to put them on hold right now. Okay, that's not really the way credit should work. The credit policy acts as a rule book or a playbook as to how you will actually run your business. Okay, how do you set up accounts? How do you increase credit limits? You know, and it's okay. So I really like him. I'm going to increase my credit limit. It should clarify why you are going to increase people's credit limits. Okay, it should take the emotion out of it. Okay, when do you send dunning letters? When do you put accounts on hold? Who approves really big deals? Are there smaller deals that can be approved just by the credit analysts and don't have to go to management at all? But so it's a rule book, a playbook. So we're going to take you through. If you have a credit policy in your company, you can compare it against the material in the notes. If you don't have a credit policy, there is an opportunity in one of your assignments to maybe have a go at writing one up. Okay, and that's one of the assignments that we have. It's not the only option in that assignment, but it is one option in the assignment. It'll make sense when you see it. Okay, but we'll take you through the credit policy, which is the rule book / playbook as to how we do it. So all of that comes under the terms and conditions kind of thing. Okay, so the terms and conditions being when you have disputes and you have disagreements as to how people have interpreted or what has been agreed, that delays payment. So what we're trying to do in that half of the module is we're trying to remove those excuses. Okay, any questions on any of that?
No, sounds good.
Super. Okay.
All good.
All right. So we've hit 11 o'clock, so we're not doing too badly. The second half of module 3 is teamwork. Okay. So teamwork, very important in collections. It'd be great if we only had to work within our own little world and work with credit people and collections people and never drift anywhere else. But the reality of the world is we do, and we have to work with other teams. So we will give you some indications as to who are the other parts of the business that you're likely to be working with and how to work with them. Okay, marketing is one. Okay, we've called it out in the notes. All right, so marketing is a key one. My best example in terms of marketing again was years ago. We started branching when we finished our venture into the Middle East. We then started heading into Africa. Okay, we started doing work and selling a lot of products into Africa, which is fine, except the assumption was that you could apply the European collections model, which primarily involves phone calls and emails to Africa. Okay, and it did not turn out to be successful because a lot of the countries in Africa, they would like some form of face-to-face contact when they are doing business with you. Okay, so using the email and the phone call model where you just bombard people with phone calls and emails did not work. Okay, and we had to set up at a relatively rapid pace a scenario where we would have people based locally who would travel around, spend at least a week, a month traveling around and actually meeting the customers. Not easy to do in Africa because there's about 50 different countries. And the geography is large, so a lot of it. But so very specific people that we had to use. But that was ultimately what we ended up doing. But by the time we had it in place, we already had debts mounting up. Okay, so what you don't want to do is do something like that again. So my point is, you need to work with the teams who are kind of planning. Okay, well, this is going to be the next big thing. These are going to be the new products. These are going to be the new geographies that we're going to do, because there may be challenges to it that the credit and collections world need to be aware of. Okay. So it's marketing, sales. I mean, traditionally, the stereotype is that sales try to book the revenue, and then collections stand in the way. Okay, I mean that's our credit manager can say, no, you can't do that. It's over the limit. It's overdue invoice. That's the kind of thing that that's maybe the old model and the one that hasn't worked that well. The new model that we would recommend and that we recommend in the notes is quite simply get hold of the information ahead of time from the sales team. Okay, who are the customers they're going to be targeting this month? And you go and you proactively have a look and say, okay, how are we for credit limits on that? How are we for overdue invoices on those guys? Okay, and proactively work with the sales team to say, okay, these ones are all fine, but these ones are going to cause you some problems. And maybe when they're having the discussion about more business, they can also say, listen, you and I both want this business, but you need to pay that overdue invoice that is just that has fallen overdue in the last week or two. Okay, it's an opportunity for you to engage, help the salespeople book the revenue, but they can help you to get the overdue invoices in. Okay. So we cover off how to work with sales, how to work with operations. Okay, so you're going to need operations because you want them to get main thing you're going to need operations for is to get the things right in the first place. Okay, You don't want the orders going wrong. You don't want the invoicing being wrong. So you need to work with them. You will also rely on them when things go wrong. They will be responsible for processing the credit notes as well, usually. So you need to work closely with operations and get that done. And then the last one that we talked to you about is how to work with service departments. Okay, you don't want a scenario where you have a very good customer service team who are providing brilliant customer service for your customer, and you are tearing your hair out because you can't get a hold of the customer anytime you ring them looking for payment. Okay, you want a scenario where that service department says, oh, right, oh, it's you. Let's see, our collections team want to have a word with you. So before we provide you with the really good customer service that we're going to give you, you need to talk to Paul, because Paul wants to have a word with you in terms of some overdue invoices. Okay, so if you don't work closely with your service teams, the great customer service will continue. You continue tearing your hair out. If you do work closely, one will complement the other, and they will pass them on to you when they call up looking for support, so that you can talk to them about what it is you want to talk to them about. All right. So we're going to cover all that off in module 3. And then the last thing of what I said was a meaty module is we are going to talk to you about DSO. Okay, so days sales outstanding and how to calculate it. Okay, doesn't really come under the heading of either the collections one or the teamwork or the terms and conditions, but it's an extra thing that's covered in module 3. Okay, so we're going to talk to you about how to calculate that. The reason DSO is very useful is it's a good comparison as to how the company is doing. Okay, if you say, you might have a very large company, and then somebody might say, okay, well, how much debt is overdue in that company? It might say 2 million. 2 million as a figure on its own means nothing. Okay, if there's 2 million overdue and the company has only billed 2 million in the last year, yeah, that's a problem. Okay, that's a poorly performing credit function. Okay, if there's 2 million outstanding, but the company billed 1 billion last year, then 2 million is nothing. Okay, but what DSO gives you is it gives you a good comparison as to how the company is performing in terms of getting their debt in versus their credit terms. Okay, and so for example, if there is say 50,000 outstanding on the debtor's ledger, and the company bills 25,000 a month, so that it is essentially taking them 2 months to get their debt in. Okay, I know that some companies will be ahead and some companies will be behind, but if you just take the ledger as one amount, it is taking approximately 2 months to get the debt in. Okay, now if the credit terms are 60 days or maybe even 70 days, that's not bad. Okay. If the credit terms are 30 days and it's taking me 60, then it's taking about twice as long to get the money in than it probably should. Okay, so we're going to explain to you what DSO is. We're going to explain to you why it's a good comparison, albeit not the only thing you should be measuring. Why it's a good way of comparing collections performance across companies, and there's a variety of different ways to calculate it. So we're going to take you through that and show you how to do that. Okay. All right. So I'm very quickly going to rattle through module 4, unless there's any questions. Okay. So module 3 is the meatiest one, but module 4 is somewhere we're getting towards the end. It's probably one of the more straightforward modules to go through. But module 4 deals with collections. Okay, it's the last letter that we haven't dealt with in the tech model is collections. Okay, now there is a collections module where we deal with things like how to make a phone call, the tone of voice to use, the type of words to use. All of that is covered in a collections module. So you'll be doing that in February. Okay, so we're not covering that off now. What we are covering off is the stuff around collections, and particularly when things go very bad. So we cover off, before we get to the very bad stuff, we cover some positive ones. So we talk about things like customer visits and how to prepare for them, and what to do while you're on your customer visit and what to do after your customer visit, the note taking and the minutes and issuing that and getting agreement and so on. So we're going to cover all that off in there. We are going to show you how to distinguish between can't pay, won't pay, and shouldn't pay. Okay, because that should be established fairly early on, because your strategy for each of those is completely different. Okay, so there's no point bringing a customer forever and a day if they have no money. Okay, it's the wrong strategy. Okay, if they genuinely have no money, it's the wrong strategy. So you do need to group your customers once they reach overdue. Okay, well, is this a won't pay, a shouldn't pay, or a can't pay? Okay, so we're going to take you through that. And then we're going to focus, I suppose, primarily on the can't pays or the in and around the can't pays. We're going to talk to you about liquidation, okay? How to, I'm just going to message up saying my computer is about to start, but so if I fall off, that's where I've gone. But there will be, let me see, we're going to be covering off things like liquidation. Okay, so there are a couple of different types of liquidation. There are voluntary ones, which can be quite simply a small partnership where both partners have maybe decided to retire and walk away with their money. So that's and nobody else can take it over. So that's a voluntary liquidation. An example of voluntary liquidation. Then you have compulsory liquidations where the creditors are more involved. It's more them that are pushing to get the company wound up so that they can get a portion of their debt back. So we're going to talk to you about the types of liquidation. We're going to look at receivership. Okay, so if you've brokered, if you plan things in the right way, or if you're efficient in terms of leveraging the courts, you may be in a position to, I mentioned way back earlier on at the beginning of this discussion about €150,000 car, you may be in a position to put something over that car, which you can then use to enforce and seize the car if the debt goes bad. So we're going to talk to you about receivership. We are going to talk to you about examinership, which is a period of protection which companies can be placed under to allow them to trade quietly and calmly without people like ourselves calling them every 5 minutes for money, so to allow them to trade their way out of trouble. So we're going to be talking to you about that. And then the last thing that we cover off, I think, is creditors meetings, is it? Yes, it is, yeah. So we're going to talk to you a little bit. Declan mentioned at the top, if you get an invite to a creditors meeting, Declan is definitely your man to contact in terms of how to handle it. But we're going to give you some initial information as to how to work when you receive notifications of creditors meetings and what you need to prepare and what you need to do at the meeting. Okay. So I mentioned it was a whistle-stop tour. So that felt very whistle-stop, but we are actually on time, which is good. Any last questions about modules 1, 2, 3, or 4?
When you say module 3 is the juicy one, you mean it's the hardest one?
It's probably got the most detail. It's got, well, no, I would say it's got the most topics. I would probably say number 2 is maybe has the most detail because it's very much looking at your order to cash process and what is right and what is wrong. So it goes into, and there's a number of different ways of slicing and dicing it, which we cover in module 2. Module 3 has probably the largest number of different topics because DSO is in there, the Incoterms are in there, the creditor payment terms are in there, and the terms and conditions are in there. So there's a lot of different topics in there, but you move on from topic to topic. Module 2 is primarily on one topic until you get to the payment terms. That's the second topic in there, but there's quite a bit of detail on that.
Okay.
Yeah, and I suppose, I hope you're getting the impression. You see, a lot of people, when they think about credit management, they think about debt collection. And they think of the credit controller as a debt collector. But to be honest with you, there's so much more to credit control than just collecting the debts. Now, obviously, that's what we have to do. And if we put all the building blocks in place, and that's what the course is going to cover from start to finish. And there's words that will be repeated throughout the course, which is to get it right first time. And that's really what we want to do. So from the start to the finish, if we can get everything right, then the job of getting the money is so much easier. Whereas if we're sending out wrong invoices and we've queries and we've problems and we've all sorts of stuff and our documentation isn't up to speed, we're wasting our time. And so it's about taking ownership for it, and and again, just getting the ideas from the course as well. So we're hoping that this will be practical, that the stuff that you will learn, that you can come in and implement in the job. And in terms of, I know, Paul, your focus was on business to business, and a lot of it is, but for the benefit of people who are involved in consumer credit, consumer is also covered, and the differences between, the different sections. So I think it's widely encompassing. I hope you find it interesting. I hope you find it good. So look, I will stop the recording now just to